Welcome back to another video from JC Trading. Chris with you today, and I'm going to cover something which I think the term gets used a lot, but no one's really sure what it is that we're actually looking for, and that is liquidity. You'll hear lots of traders, including myself, talking about liquidity sweeps and grabbing liquidity and sweeping liquidity. Now, there is several types of liquidity. Today we're going to be looking at stops. So you've probably heard the expression stop hunting. Liquidity sweeps, as I said, is probably the more common term. There is going to be more videos on this because it isn't as clear cut as you just need to do this. However, what I would like to show you, we'll go to a blank piece of screen to start off with. So liquidity is where there are orders in the market. Now, orders are basically stop losses. When you have entered a trade and you expect to go long or the market to move up, you'll place an order and then your stop loss will be underneath it, and obviously as long as the market goes up, your stop loss safe, you make money. If the price comes against you, then obviously you lose money, and that order, that sell order, is then actioned. So your stop loss, you need to consider it as an order, although you're placing it to obviously cancel your trade. In essence, it's an order. So by this, what I mean is, and there's numerous reasons why people get into trades, but if we see the market doing this, for argument's sake, there is a very good chance that if you go long, you potentially might win a trade. It's going in an uptrend, it's making higher highs and higher lows, higher highs, higher lows. So people are going to be entering into trades. Now, it might be just because of a trend, it could be because of a trend line, it could be because of the fair value gap was inversed, it could be because we bounced off an EMA. There's a million reasons why, but ultimately, as price is moving up, we are going to be making limit orders. And the reason that we're making limit orders is because people are getting in. They're placing trades to go long and they're placing a stop loss. Price goes up, it breaks this high, so that again might be another reason why someone would decide to get in. So when price starts to pull back, they place another order, a long order, so we get a stop loss that will come in here. So, and as this goes up, you can obviously see the further it goes up, the more orders that are accumulated on this leg. So if it keeps going up like this, there's going to be stop loss orders all the way along here, and people might be trailing their order. If they placed an order down here, they might start trailing their stop loss up to these lows. But we're building up a lot of liquidity underneath us because people are trailing stop losses, or they've left the stop place in the original location. So this is what is termed as liquidity. So occasionally what you'll see is a liquidity sweep, and that is where the market will just suddenly come down and will actually sweep liquidity. It's taking those orders, it's activating the order, which would be a sell order in this instance, because obviously we've been placing buys, or people have been placing buys all the way up. So these, your stop loss, are sell orders. So this is a sweep of liquidity. And then what you might see is that the market will, once it's got this, will then start to come back up again. So wherever you would think a stop loss to be placed, generally, this is obviously a very oversimplified scenario, but if it looks very obvious, that probably means that people have entered, and you can pretty much guess where stop losses are. In this example, it was very, very clear that at these lows, there's going to be stop losses, and it doesn't matter why people got in here. It may have been that we had some kind of trend line running up and people were saying, well, it's bouncing off of that, so we bounced here, I'm entering, we bounced here, I'm entering, we nearly bounced, I'm entering, we bounced, I'm entering. It could be that it inverted a fair value gap here or here. It could be that there was an EMA line that was running sort of along here, or a VWAP, and as I said, there's 1,000 reasons why people would enter. But this ultimately is where the stop losses have accrued. So if we actually get rid of all of that, and I'll just see if I can do it in one hit rather than do it individually, done. If we go back to live markets, we can actually start to see this. So I'll zoom into here first. So this price action is very similar to what I've just drawn. We've put in a high there, a low. We've now broken that high. So technically we've broken market structure, so we're going long. So there's going to be stop orders here, or probably here, but ultimately there's going to be orders residing under these lows. So we've broken up here, and people are like, okay, we're in an uptrend, we get a pullback, we then get orders coming in here, we go up, but then when we do come back for what looks like it might be the next pullback, you possibly have got people entering here as well. Suddenly we get this big drop in the market, and if you look at what that's done, that's taken the liquidity from under here, or the stop losses. It's taken the stop losses that were under here and has ducked down into this area here. So what the market has done is swept liquidity. It's taken liquidity because anyone that had the stop there is now out. Anyone that had the stop there is out. And again, although you see it as a stop, what these actually are sell orders. So we also see something very similar again here. We start, we've come down to a low, we've pulled back, we then pull back as a slight correction, and then we then break this high. So you might consider, or some people, depends on your trading strategy, okay, right, we're now going to make a break to the upside. So you could have some sell orders here, stop losses, because we've had this pullback, we've started to come up, and people are thinking, okay, I'm going to go long. Well, rather than going long, we had the same things it done here. The price has actually come down and swept these areas here where there might be potential stop losses. And you see this again and again and again. Now bear in mind there are numerous types of liquidity. This is just one type of liquidity. I can do more videos about session liquidities and highs and lows and anything else that you want me to do really. This is another good example. You can, when you zoom out of the charts, it's often easier to see these kind of sweeps. So if you look here, where's my arrow gone? If you look in this area here, there probably was stop losses residing here. We've made a push up, we've come back, which could be seen by some as a pullback. We've started to push up. So there's probably orders. Now if you look at this candle here, see the very, I'll zoom in for this one, you see the very long wick. The body didn't close that low, but look at the wick, how low it come. And that is perfectly aligned with where potentially stop losses might have been residing. If I was placing a stop loss, that's pretty much where I would have placed it. So that would be termed again as a liquidity sweep. We've also got the market moving down here. So if we look at that previous low there, and the market started to move away with some aggression. There's a fair bit of momentum there. We've put in a lower high here, then we break it, so we've broken market structure. Everything's looking like we are going to be making a break for possibly these Asia highs, possibly there was a news high, or I think we've still got a London high and an all-time high above us. So it's making it look like it wants to break. It's breaking up, so people are placing their stop losses, they're going long, they're pretty convinced for whatever reason, and whatever the entry model is, but they think that it's going up, so you've got stop losses accrued here. Now the market then comes down and sweeps that area, and that area, and if you look here, the actual final sweep was this one wick that come down. But then notice what the market done afterwards. Then it made a move up. Now that's the move that everyone thought potentially was going to happen over here. So everyone is going long and they're placing the stop losses, but what it done was obviously swept the liquidity and then it decided to move. And then it's gone up to here, we've come down. Now if you look here as well, with this retracement here or correction leg, anyone that was still going long all the way up there has been swept out. They've been taken out of the market there. It's come all the way back to this low here, and then what happens? It then goes up. And liquidity can be seen as it's fuel. The market, if you consider the market as a car, you need fuel in your car, whether it be diesel or petrol. In order for the car to move, it needs fuel. In order for the market to move, you could consider the fact that it needs liquidity. Liquidity is fuel. So this is almost it filling up at the petrol station before it then goes off. And again, here you'll see big sweeps. If we just zoom out here, this move down here was more than likely a liquidity sweep. We've come down to the previous session low. Session low, session high are also areas of liquidity that like to be swept. I will go, as I said, I can make more videos, but just to keep these short, I'm only going to be covering stop loss liquidity today. But if you see this huge drop here, sweeping up liquidity from this low here, and also, well, pretty much making an equal low with the session low, not quite, but nearly. So that is stop loss liquidity. And when someone says, or you hear someone comment a liquidity sweep, that's what we're talking about. And generally with stop loss liquidity, you have to think, what would 90% of the market be doing right now? What are retail traders doing? What is the average Joe trader going to be doing? And generally it's things like, we've had a market structure shift here, we've broken this high, so we are now going up, we're going to be going long. As I said, it could be based off EMAs, it could be based off this particular trade here. We could say that it is possibly a trendline trade, so, or probably from there people are thinking, okay, we've bounced off of the trend line here, we've bounced off of the trend line there, we're going to bounce again here, and we start to push up from the line. So you potentially would have people going long because they're trendline traders. You could have had an EMA, a VWAP. As I said, there's 1,000 reasons why people enter trades. Ultimately, what it means for you as a trader is, if you don't identify where these liquidity areas are, so session highs and lows, and obviously stop losses, you're more than likely going to end up being liquidity. I think I heard a phrase that coined it perfectly. If you can't see liquidity, you will become liquidity. And I think that's a really valid comment. But that has been stop loss liquidity. Hopefully it's made sense. I tried to make it as simple as possible using analogies that is going to be understandable for all levels. But if you've got any questions, drop them in the comments below. We trade every day on our Discord, and obviously liquidity is a massive part of it. It's a free Discord. Feel free to pop over. I'll put the link in the comment or in the description box below, and hopefully see you over there. Take care. Bye.